Picture this, a single, crisp dollar bill. It leaves a massive global philanthropic foundation, crosses international borders, and finally lands safely in an Indian bank account. Now, to most people, that arrival, well, that seems like the end of the journey. But in the high-stakes world of legal compliance and international finance, that's exactly where the real story begins. Today, we're on a mission to uncover the legal mysteries behind foreign funding in India as we decode the heavily debated FCRA Amendment Bill of 2026. This isn't just some dry political headline, you guys. We're talking about a deeply complex financial maze that literally impacts global donors, local charities, and even massive infrastructure projects.
So the core investigative question here actually seems pretty simple, right? Where does the money go? But when foreign funds enter the country, it's not just about who sent the money or, honestly, even who received it. We have to ask, what does that money earn? What does it create? And absolutely crucially, what happens to the physical assets it builds if the receiving organization's legal status just suddenly changes?
To really wrap our heads around this, let's look at a massive hypothetical donation. We're talking 100 crore rupees. Let's say a global donor wires this staggering amount to an eligible Indian charitable organization. If you want to know exactly how the government tracks every single rupee of a sum this massive and what the proposed laws mean for its future, hit that subscribe button right now and stick around. We're following the money trail all the way to Parliament, and trust me, you do not want to miss a single step of this.
Section 1. The Foreign Money Journey.
Okay, let's dive into this. Like we established, the arrival of that 100 crore rupees is merely the starting line. Once it enters India, the journey of those funds becomes this incredibly continuous, tangled web. And actually, let's clear up one of the biggest misconceptions out there right off the bat. People often think that just having FCRA registration means you automatically get a free pass on your income tax. Absolutely not. There is a massive, fundamental legal distinction between the two. The Foreign Contribution Regulation Act, or FCRA, dictates exactly where the money comes from and how you're allowed to accept it. Income tax, on the other hand, is governed by completely separate rules. It dictates how that money is taxed or exempted. Having one definitely doesn't guarantee the other. You literally have to navigate both of these complex frameworks simultaneously.
Section 2. Current law versus the proposed bill. So, under the existing bedrock of the FCRA 2010 framework, the government actually notified new rules in June 2026, and those are already fully active and operative. But the big topic we're unpacking today is the FCRA Amendment Bill that was introduced earlier in March 2026. Now, it's absolutely vital to note that this is still just a proposed bill. As of August 2026, it's been referred to a 31-member Joint Parliamentary Committee, the JPC, for some really deep scrutiny. So whenever we talk about these massive upcoming changes today, remember, we are talking about proposed amendments that are still being heavily debated by lawmakers.
Section 3. The Designated Authority. This brings us to where the stakes get incredibly high. The 2026 bill proposes adding a brand new section, Chapter IIA, which introduces a profoundly powerful new entity called the Designated Authority. Just take a look at the sheer scope of control this proposed authority would wield. If an organization's FCRA certificate is canceled, surrendered, or just ceases to exist, the foreign contributions and assets initially become provisionally vested with this designated authority. And if that certificate isn't renewed, well, that vesting becomes permanent, and those assets can be completely transferred to government departments. Plus, this authority would have unhindered access to all books of accounts and would possess the exact same powers as a civil court to summon people and demand documents. It's a very clear signal emphasizing the government's firm stance on improving transparency, accountability, and stopping any potential financial misuse of foreign funds in its tracks.
Section 4. The Mixed Funding Challenge. Now, here's where the theory hits a massive logistical brick wall. I mean, this is literally a nightmare scenario for accountants and legal teams. Imagine a 50 crore rupee hospital. 20 crore comes from foreign contributions, 20 crore from domestic Indian donations, and let's say 10 crore from a standard bank loan. It is one single physical building, right? Well, if the organization loses its FCRA status and this new designated authority steps in, how exactly do you divide the hospital? You can't just take a saw and physically cut a hospital in half. Separating the foreign-funded bricks from the domestic-funded bricks becomes this massive, almost impossible forensic hurdle.
And you know, this specific debate is exactly why the bill is currently under such intense parliamentary scrutiny. Because how do we protect the rights of the domestic donors who helped build that hospital while still properly regulating the foreign funds? I actually want to pause right here and ask you guys directly. Should foreign-funded mixed assets have a special legal framework when a registration ceases? Drop your thoughts in the comments below right now. Seriously, I would love to read your take on this deeply complex issue, because there are no easy answers here.
Section 5. Appeals and Safeguards. Now, whenever vast new powers are proposed like this, we absolutely must look at the built-in safeguards. If an organization is unhappy with an order from the designated authority, the proposed bill does include a formal appeals process. Once the initial order is issued, the aggrieved party has a 90-day window to file an appeal directly to a district judge. Critics of the bill have definitely raised some serious concerns regarding government discretion, due process, and the potential chilling impact on legitimate charities that rely on global philanthropy. But on the flip side of that coin, the government argues these strong, specific regulations are essential, non-negotiable safeguards for national interest. The JPC is currently balancing these exact arguments to ensure a fair procedure for everyone involved.
Section 6. The Compliance Checklist.
So what does this all mean for you if you are running an organization today? Listen up, because if you're a trustee, an administrator, or tax professional, the days of just quickly filing an annual form are completely over. You must validate your registration immediately. You have to surgically track and separate your foreign versus domestic sources. Seriously, no more mixed buckets, it's just too risky. You need a rock-solid, defensible, documented history for every single physical asset you own. You have to ensure your income tax returns perfectly align with your FCRA reporting. And most importantly, you have to have a bulletproof plan for what happens to your funds and assets if your FCRA status suddenly changes tomorrow. Financial accounting is no longer just back-office bookkeeping. It is absolute frontline legal risk management. There's a brilliant quote from a veteran tax officer in our source material, and they framed it with just profound simplicity. They said, "Every rupee should have a source, a purpose, a document, and a destination." Honestly, if you are managing foreign funds in any capacity, this should literally be framed on the wall of your office. An undeniable, crystal-clear paper trail is quite simply your only real shield against legal ambiguity.
As we wrap up this deep dive, I want to leave you with a somewhat provocative thought to help you analyze your own readiness. Go ahead and look at the assets your organization holds right now. Look at your buildings, your equipment, your bank accounts. Can you definitively, without a shadow of a doubt, prove your assets' entire funding trail? Because under the proposed FCRA 2026 amendments, failing to answer that one question could literally cost you the asset itself.
We have unpacked an incredible amount of critical, high-stakes information today. If you found this explainer of the FCRA 2026 bill valuable, do us a huge favor. Smash that like button, subscribe to the channel so you never miss an update, and please share this explainer with every administrator, trustee, tax professional, and policymaker in your network. This is legislation that is poised to fundamentally reshape global philanthropy and local charity in India, and everyone needs to be informed. Thanks so much for learning with me today, and remember, always follow the money.